Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, mutual fund analyst from Scope Analysis. For today's session, I'm very honored to be joined by two guest speakers. Joining us on the line from Hong Kong today, we have Ken Wong, Client Portfolio Manager for China Equities at Eastspring Investments. Good afternoon, Ken. Great to have you here.
Thank you. Pleasure to be here.
So next to Ken, we have another guest, Martin Fechtner, who is a Senior Portfolio Manager at ODDO BHF. Martin is an old friend of Scope. We know him way back when he was the head of mutual funds team, and he's certainly a seasoned Asia investment specialist. He's joining us on the line today from Frankfurt. Good morning, Martin. Great to see you again.
Good morning, Manqing. Great to be here.
So our discussion today is a featured segment of Scope's Asia Investment Special Series. And this time we will tap into the China equity market, which is dominating the headlines. The asset class has been through a roller coaster ride this year, from a record high in February to a violent cut in the waist during the past month. From being the apple of investors' eyes as an alternative to US equities to a big question mark whether it is still investable. I'm sure you all have a lot of questions. Here's how the hour is going to work. We will break it into two sections where Martin and Ken will lead the discussion about some of the most concerned topics, including the rationales behind the recent regulatory crackdowns, its implication on the market and on foreign investment. We will look into sectors that could sustain or potentially benefit from the regulatory headwinds. We'll also zoom into sectors that are under great spotlight, for example, the likes of China's property market and technology sector. The two of them will also share their views on US-China relationship and the region's growth outlook. Following that, we will open the second section for Q&As. In fact, a couple of our audience have already submitted their questions prior to the webinar. And we appreciate it very much, and I just wanted to know that we will cover all of them today in the session. Before we begin, I'd also like to remind our listeners with few logistics, we will also have time for We'll have time for your questions, so please submit your question anytime under the section Fragen. And finally, a webinar replay will be made shortly after the live event. You could rewatch the clip on our Scope Explorer at any time you want. So, okay. So to frame today's discussion, let's maybe start with some high-level context. For our listeners who may not be aware of the full extent of the recent government actions in China, let me start by setting the scene with some high points here. So in the last 12 months, we've seen tightened policy in the real estate market in China in terms of directives of the banks on how much they can lend to the real estate sector, in terms of mortgage financing rules, and also around land sales. Then we have seen the big news of tech companies in China, where the government was trying to break up the monopoly of country's big tech titans. The Alibaba's financial ambition, the Ant financial IPO was pulled, and we've seen a fine on the company when the IPO was pulled. And we've also seen fines imposed on Tencent for unfair market practice in online music, and followed by intensified rule against its gaming empire. And then the next we've seen in the news, the crackdowns on ODDO, the country's largest ride-hailing app, right after it had listed in the US, and on Meituan, a popular food delivery app, after trying to keep sensitive consumer data or biometric data within its borders. So in addition to that, the government also pushed for better social benefits, such as minimum wage and health insurance for gig workers and contractors who work for those apps. And just last Friday, the High Court in China issued a memo striking down the so-called 996 working culture, the overtime working from 9 a.m. to 9 p.m. 6 days a week, and which is very common when you work in those big techs in China. So, and finally, over the last weeks, we've seen the shakeout in the $100 billion education industry, where the government trying to stamp out private capital funding its education sector. So, Ken, it's been really an eventful year to invest in China. So could you explain the rationales? What are the reasons behind this series of crackdowns on private companies? And perhaps a follow-up question to that, do you think that China turned against private companies in general?
Okay, thanks very much. I think that's a great question to start off with. The fact is that, when a lot of our investors, who I spoke to over the past few weeks or so, they've asked, why has this happened all of a sudden? Especially, sort of over the past, since July, so pretty much over the past 7 or 8 weeks, everyone, a lot of investors, especially outside China, have just felt that, just everything just happened so suddenly. But the fact is that, there's been a lot of actual talks of regulations and specific clampdowns on a lot of the new economy sectors actually over, over the past couple of years. But a lot of those talks intensified over, sort of the past 10 months or so, from drafting of guidelines to specifically President Xi talking about how China needs to protect, sort of healthy developments of new economy sectors. Then there was a lot of talks in regards to, sort of monopoly and duopoly within the tech sector, which, creates some of the sort of uncertainties within the, sort of within society. And so, as you mentioned earlier, then, you had a lot of sort of other news in regards to company-related information or company-related, sort of stocks such as, sort of Ant Financial to DiDi to Meituan, and then more recently with companies like EDU as well as TAL on the education sector. A lot of these things, has happened because the fact is that China, in its own way, is trying to really develop, sort of its own model for its own ESG purposes. And the fact is that, especially on the S side, China is really going through, sort of a lot of changes on the E side already. But on the S side, in terms of the social responsibility, what they felt and what they saw was that, as a result of, sort of COVID and what happened afterwards was, sort of a lot of liquidity was injected into the system, and that created more social inequality, that increased the Gini coefficient within China, and just created, a lot of these uncertainty. And so as a result, China and the Chinese government in general, they had to step in. They didn't really have a choice as to, sort of, seeing what some of the things were happening. The fact is that, you have an aging population, but you're not having enough families wanting to, raise kids because of the higher costs. And a lot of these things have really just created, some of these sort of recent events that's been out there. But the fact is that when you look at, reform, or specifically when you look at policies and regulations, it's happened in China, and it's happened across a number of different sectors over the years. And you can see here on this particular chart and this particular timeline, you can see that, there were certain periods where things evolved and, really developed. And then, and you can see that in the green. And then when things started to be, sort of tighten up, you can see that specifically within the blue periods that, things do tighten up as time progresses in order to sort of balance out some of these developments within the various sectors. So again, this is nothing new. This is something that has happened, sort of throughout the years investing in China, and something that investors do need to be mindful of when they're investing in a market like China.
Mm-hmm. So, and I think, what's your theory, Martin, if the purpose was not to reduce prospects and curb private companies, and which is the main driver is economic growth, what might be the intention of recent crackdowns?
I mean, first of all, I think it's really, really important to highlight that I don't think that China is engaging into a war against private companies. And I mean, there's one simple reason I don't think they turn against private companies. The reason is quite simple. Private companies are extremely, extremely important for China, for China's growth, to achieving economic targets, investments, achieving the employment targets. I mean, just to give you some context, almost 90% of the urban employment comes from the private sector. 90% of new jobs are created by private companies. 2/3 of the GDP growth is coming from private companies. So private companies are extremely, extremely important to sustain growth in China, to sustain employment, and to create wealth for the communities. So that's the reason I'm really confident, and I know there are some headlines in newspapers, there are some question marks among investors, but I'm very confident that China remains supportive for private businesses. But maybe to add some aspects, I mean, when we talk about the internet space, we're not talking about small companies any longer. We're not talking about startup companies. I mean, we're talking about quite huge companies like Alibaba, Tencent. I mean, the digital industry in China makes up almost 35% of the economy. So we're talking about huge businesses, and businesses that have, to some extent, from many aspects, largely unregulated. So I think this is really important to understand the government motivations behind that. And as Ken said, I mean, we have seen many of the discussions in the Western world. I mean, when you think about monopolistic behavior of companies, when you think about cybersecurity or data protection, these are all important aspects in the West. In China, in contrast to some of the Western countries, decided to act now, and when they act, they act with decisive steps. And I think also that it is really important not to mix up too many aspects of this regulation. I mean, when we talk about education, and I think education is a different animal. I mean, the tutoring sector, I mean, is obviously a sector where the government did de facto a ban on the whole sector on generating profits. But you have to understand what the motivations behind that is really. I mean, when you look at how much a household spends in China for tutoring services, I mean, it's really, really substantial. On the other hand, China has a huge demographic problem. So for many families, it becomes really, really difficult, to raise kids because it's too expensive. That was the main reason behind this step. We could also talk about the end IPO, and I think many people thought this is just like a Chinese version of PayPal, but indeed it's much bigger, and the business is much more comprehensive because we're talking about one of the biggest lending companies which has never been really regulated as a bank, as it should be. So also this step is understandable. So we have seen the cycles over and over the last couple of years in gaming, and I think we really lack somewhat of communication, but many of the measurements the government is taking actually are healthy and important for the development of the sector. I mean, does it mean that big companies would suffer from it somewhat, maybe grow a bit less? Talking about big platform economy companies, yes, certainly, but nevertheless, I mean, if the Chinese government is doing it the right way, it could be beneficial for the overall economy and the development of the country.
I guess the common theme that runs through all these policies when it comes to investment in China, I think, is we all know that the Chinese government very much value the social economic stability, and a lot of policies coming out of it, it tends to be rooted in maintaining the stability and within the country. And just to follow up your point, actually discussions about how to regulate big techs and promote competition, how to bring education costs down, how to try to take some of the speculation out of the property market, how to protect data and promoting equality. These kind of discussions take place everywhere, every day in the world. And of course, there's certainly nuance to that, but for years, there's been a lot of criticism towards China in terms of lack of compliance and regulatory oversight. Now, when the wave really comes, the market is apparently spooked and criticized from the other side. And here's a question, and let me start with you, Martin. Why are investors so shocked by the regulatory moves in China, and while being relatively, let's say, relaxed on policy changes in Western countries?
I think this is a good question, and let me try to give you an answer on that. Because I mean, obviously, when we talk about China, we're talking about different political systems. When you think about regulatory steps in the Western world, I mean, we have long discussions on that. Yeah, there are drafts, there are papers that are widely discussed. I mean, we have a process where the parliament is involved. Then you have courts, right? You could block cases. So it's a process that takes years, and it's a parliamentary process. In China, obviously, it's a process that came up overnight, basically, right? I mean, the communication wasn't that clear. I mean, we had a lack of transparency when the government announced these steps. So it was really difficult for investors to get the context right. And obviously, I mean, the first step of this regulatory cycle was the cancellation of the end IPO, which was the biggest IPO, and they just canceled it a couple of days ahead of the listing. So that scared people, yeah. And the second issue was, obviously, which really scared of people, was the regulation education, which was everybody's darling. So it was really a favorite sector among foreign investors, and many people thought, or draw the conclusion out of what happened there, that the government turned against private companies, which is not the case, but the way they communicated things made it really difficult. And let's also not forget about one thing. If the Chinese government tells a company like Alibaba, you're a monopoly, you have to fix your business practices. And I think actually it was behavior you can criticize. I mean, the company has to change practices overnight, which wouldn't happen in the Western world. It takes lots of time. So at the end, I think it's really we're coming from a world in China where many sectors have been basically unregulated, to environment where the government is coming up with extremely strict measurements, maybe more strict than in the Western world, and the way they communicated all these steps, I mean, has scared off people.
So Ken, what was the impression and message you are getting from institutional clients or investors when you communicate to them? So how would you characterize the in-house view of portfolio managers across Eastspring's investment teams at the moment, especially with regards to China?
Yeah, I mean, at Eastspring, we're very much medium to long-term investors. So, despite the recent volatility and the noise that's been going around, sort of in regards to some of the negative sentiment around China, we're taking this as an opportunity, especially, in July when there was a fair bit amount of correction to, enter into certain positions. When you think about it, some of these tech names now, the likes of Tencent and Alibaba, which Martin mentioned earlier, these companies are now sort of fitting into the value style bucket, right? The fact is that, prior to this, sort of shock within the internet space, no one could fathom that, potentially that Tencent and Alibaba could actually fall within a, sort of a value bucket style, but it has. But at the end of the day as well, the way we look at it is, China is a very big market. You have China A shares, you have then the China listed, the Hong Kong listed China shares, and then you have the US ADRs for these Chinese companies as well. The big difference is the fact that when you look at the internet, and specifically education sector, the fact is that only 0.1%, sort of these stocks are listed in the A shares. In Hong Kong listed, it's roughly about 30%, and ADRs is over 40%. So you can see that, we have definitely seen more volatility within the Hong Kong listed space as well as the US ADRs. But we've seen how A shares, especially the onshore listed in Shanghai and Shenzhen, the markets have been still somewhat immune to what's been happening, because the fact is that when you look at what's been going on, specifically within domestic China, there's been a lot more stocks which have been sort of beneficial and enjoying the tailwinds of the various government policies. So we're seeing more and more investors also out identifying the fact that, hey, A shares tends to be a probably a bit less volatile way to actually enter into the China market, especially for those who are more keen towards really that that domestic flavor of the China markets. If their push is very much going to be on sort of China's reliance on technology independence, or specifically focusing on consumer discretionary sectors, or focus on, let's say, renewables, the likes of the various EV suppliers, solar, along that space, or even maybe healthcare and sort of more defined healthcare companies. There's a lot of these listed on the A share. So we're definitely starting to see more investors overseas who are interested in it. And I think the facts also show that, because if you look at the Stock Connect program here in Hong Kong, the first 6 months, we already saw roughly about $33 billion of inflows. All of last year, as compared to last year in 2020, there was only $31 billion worth of inflows for the entire year, sort of with the northbound, so with foreign investors via the Hong Kong stock market, Stock Connect, buying A shares. This year, first 6 months, we've already seen that number basically, sort of, matching what we saw back then. So those are very important aspects, when it comes to, sort of what's going on there in regards to the marketplace. And overall, I think so maybe if I can sort of get your attention to that to this one slide as well, which is when you look at overseas investors, in particular U.S. investors, right now at the moment, they're still very little invested within A shares. They're more invested within the H shares, U.S. listed Chinese assets or sort of Hong Kong stocks, right? There's just a lot more participation there from, in particular, the U.S. investors. When you look at the Asia market, the participation rate is still very low, and this is really where we think there could be quite a bit of opportunities for investors who want to continue to ride this strong opportunities within the China market.
So now there's a negative sentiment around foreign investors who now feel all investments could be potential targets, and nothing seems off limit. As a matter of fact, Chinese government has put a lot of efforts on the opening up of its capital market. So 1 minute we were talking about whether China would be the new safe haven, and the next thing we know, people are worrying whether it means the end of capitalism there. So let me start with you, Ken. What is China's attitude towards foreign capital?
Well, the fact is that they still want to have foreign capital. Obviously, we looked at FDIs. It might not be specifically what it used to be. The fact is that China now has a very big domestic market, and they feel that they can really sort of have enough support domestically. But the fact is that there's always a demand for foreign capital to really help sort of capitalize the country to some extent. What China needs to do is they want to ensure that investors, especially the minority investors within China, are being are being looked after. One of the differences I would say comparing China with other markets is the fact that the regulators in China are much more stringent when it comes to approving listings. The fact is that a lot of companies who list on the A shares in Shanghai as well as in Shenzhen go through a very rigorous process. The fact is that they could spend a year, 2 years, or even more in order for the regulators to make sure that the companies which are being listed are financially sound, are fairly strong companies, and they're not just kind of cooking their books in order to list on the markets. The fact is that sometimes when you look at some of the listing rules in Hong Kong or as well as in the U.S., they will tend to be a bit more lenient. I mean, look at the case of ODDO, right? The fact is that the company, from its filings to sort of the roadshows to listing, only took a few weeks. Again, I'm not saying that the rules were too lenient for that, but again, you can see where something like that would never happen in China, because things tend to be sort of the process and timing takes a lot more time in order for things to really evolve. And so from our standpoint, we think that that's really one of the things that the Chinese regulators are trying to do to look out for investors. At the same time, the fact is that you also have to realize that the Chinese government, people saying that they're not worried about foreign investors whatsoever. That's not the case at all. The fact is that a lot of the same companies that foreign investors invest in, the likes of Tencent or Alibaba, or any of these some of these stocks listed in the U.S. as well. The Chinese government, owns a lot of these stocks as well, right? For their, social security funds, even companies like CIC. A lot of these companies do own those offshore China stocks as well. So, they're just as well impacted. But the fact is that they're, overseeing and just not focusing so much on just what's happening in the short term. They're looking at much more sort of on a, sort of longer term basis. In order, if they're trying to make things, I would say more efficient, and sort of and more there's more benefits to society as a whole over the long term, then that's what they're going to do. They're really trying to make this sort of a very long term perspective. And of course, when you look at some of the corrections that we see in the marketplace in July and August, yes, the corrections have been steep, but if you look at it, the past couple of years, Chinese stocks have performed very well, right? And if you look at new economy stocks, it's not just the past couple of years. They perform well for quite a bit of time. So a bit of profit taking, is actually, not unexpected either, right? It's the fact that, of course, we always want to see markets just go up and, never go down. But the fact is that, there was always going to be bound to be some correction. And of course, with, the recent events that's happened, of course, I would say that some investors did take that opportunity to, take some profit off the table. But of course, as valuations now look more attractive, especially when earnings are also continuing to back, the prospects of these companies, we think the opportunities, will be good for both domestic investors within China and also from foreign investors outside of China.
Mm-hmm. So Martin, speaking as a global portfolio manager like yourself, what are the implications for international investors in this regard? And how should global investors position themselves?
Okay, first of all, let me tackle the question if China turned against foreign investors. And the answer is clearly no. Why is that the case? I mean, when you just look at the steps over the last couple of years the government has taken to open up the market, I mean, they're actually very, very positive for international investors. I mean, we talked already about Hong Kong, about the Stock Connect. I mean, a couple of years back, I still remember as a foreign investor, you needed a quota to invest into A shares listed in Shanghai. And this changed over the last couple of years. I mean, we had the Stock Connect program, and the Stock Connect program enables foreign investors to invest quite easily into the Chinese stocks listed in Shanghai, for example. So this is really an effort the government has taken to attract more foreign investments. And there are some other sectors where we've seen liberalization and where the government actually made it much easier for foreign investors to come in and invest. I mean, one example is insurance market, which is, I think, one of the most interesting insurance markets in the world in China, and where foreign companies are able to invest and they don't need a joint venture partner any longer. So these are just some examples showing you that China welcomes foreign investments. And in China, I mean, they consider themselves as a rising star to become one of the world powers going forward, and so they want to be more integrated into the financial system. Yeah, and also when you look at the currency, the RMB, which is not part of the IMF basket, this is another sign that the government is supportive. But your question was, how should you position yourself? And this is rule number one if you want to invest in emerging markets and to invest in China. You need to have a long-term view of markets. And we discussed the correction, and we've seen some panic in markets, understandably some panic. And I think we gave some context to explain why markets were reacting like they did. But at the end, if you have a long-term view on the market, on China, you find lots of attractive stocks that have rarely been that cheap at the moment. When you talk about the big internet companies, profitable businesses, huge free cash flow, superior market positions, some of them have never been that cheap. And the market is actually pricing in an extremely negative scenario where these companies are not growing any longer and margins are about to decline. I mean, as I mentioned, there's going to be an impact for the big companies, negative impact on growth somewhat. But we're talking about companies that used to grow like 30-40% that might still be growing like 25% or more than that. So I think some of these names are looking extremely attractive. And I think also, and that's what we have learned last year, looking at the Chinese market from a foreign investors perspective. Yeah? China was extremely well-performing equity market. I mean, the first economy that was bouncing after COVID-19. And obviously, China gave you great diversification benefits. Obviously, this time in the years, it's the other way around. But I'm very confident if you have a long-term perspective, if you can stand somewhat the near-term volatility, and I think the cycle is definitely not over. We're going to see some more months and quarters to come where the government is going to announce new regulations. But if you really look at the long-term picture, I think there's still a very good case why you want to be invested into China. But again, I mean, you have to try to understand what the government really tries to achieve, and the communications by the government doesn't make it so easy for foreign investors to really understand the motivations for the government.
Yeah, I think you touched up on one question that is actually from our audience prior to the webinar, and the question was, what needs to happen so that international investors can restore their confidence? And maybe a step back, what could have been done better? So let me start with you, Martin, first. What's your take on these two questions?
Yes. I mean, one point, I think I gave you already an answer to the question, what has gone wrong. I mean, communication, yeah, so transparency. And I think that the government needs to be more transparent when they communicate, really explain more what they are doing, why they are doing it that way. I mean, I think that is really important for foreign investors, especially to regain confidence. And then what could be a signal for bottoming out? I mean, I told you already that valuation looks attractive, but I think what investors are really going to do over the next couple of quarters, they're going to look at earnings results and going to have a look how these policies impacting the businesses of companies. And as I said, there's going to be an impact, but it's not going to be the end of the world for the technology companies. So I guess if we see actually that companies continue to grow in a more regulated environment, continue to post growth, I mean, investors are gonna come back. I mean, when you look at past cycles, and as we I think highlighted before, it's not the first regulatory cycle. I think it is the first cycle that targets many different sectors, from technology to property to education, but it's not the first one. I mean, typically you had a correction of like 40 to 50% in the cycle, then maybe 1 or 2 quarters where the market was flattish, and then investors are coming back. So I think investors are definitely gonna come back, but they need to regain confidence that the regulatory environment is to foster growth, to achieve more competition, and they need to have confidence that the numbers are coming in all right and companies continue to grow again.
Yeah, and Ken, what's your take on this? Do you agree with Martin?
Yeah, the communication thing is always important, right? I think investors would always love to have certainty, sort of when they invest. But we also know that a lot of times it's going to be very difficult, especially when it comes to dealing with China and sort of the regulators there. And also this is one of the reasons why sort of China is trading at a significant discount as compared to other markets like the U.S. Right? When you look at the forward earnings, China is only at around 15 times forward earnings, while the U.S. is right now, the S&P trading around 23 times forward earnings at a price to book of 4.5 times, while China's price to book is only about 2 times price to book. So, that's one of the key reasons why, investors are willing to pay a premium for investing in a market like the U.S. And they're going to, sort of discount, China quite a bit as a result of some of these uncertainty. But with that said, there's definitely bound to be, sort of better communications, especially I would say amongst the companies first to begin with. A few years ago, a lot of times, when we, talk to some of our investors and try to guide them through, some of the company visits that we made, and some of them even participated in some of the company visits and some of the calls that we had at the request of a few of the investors. And they had a difficult time understanding sort of what the investor relations team were doing, especially for the domestic sort of A-share companies. That trend has gradually improved. We're definitely seeing companies understanding how important it is to make sure that overseas investors are just as clear about the business as compared to local investors. And overall, when you talk about whether or not sort of we reach the bottom, it's very hard to tell, right? Again, I don't want the crystal ball to tell you whether or not now is already the lowest point. The fact is that valuations are at a much lower level, purely from a fundamental standpoint. When you look at sort of MSCI China and you compare its current valuations relative to history, they're below sort of their historical averages. They're roughly about half a standard deviation below their historical averages. So are we at a low point? No, not necessarily. But the fact is that sentiment, again, the past couple of months, a lot of the selling has been, much more sentiment driven than anything else. And the fact is that, over the next couple of months, sort of we'll be reaching the end of the third quarter. And, when October comes around, it'll be important to see, especially for a lot of these internet companies, what's going to happen with their earnings, in particular, because a lot of these, regulations started during the beginning of the third quarter. So we'll be definitely keeping an eye out to see, sort of what the third quarter's earnings number looks like, whether or not they surprise the market. And the one thing that you also have to also realize is that Chinese companies are able to adapt and adjust on fly, based on specifically what the policies are, which are being enacted by the Chinese government. That's one thing that's been very remarkable for a lot of these Chinese companies, and even the biggest ones like Tencent and Alibaba, or JD.com. These guys move very quick when it comes to sort of adjusting to certain policies that will have an impact. And again, those companies that can make those adjustments to their business, make the adjustments as needed in order to comply with the new regulations, as set forth by the regulators, those will be the companies that will come out of this, in a much better shape.
Okay, so thank you, Ken. Martin, then let's move on to the sectors in the investment. Let me start with you. What are the segments of the economy that, let's say, sustain or let's say are less vulnerable amid all these uncertainties, or even potentially benefit from this regulatory headwinds in China? Where do you see value across the sectors?
I think there are lots of sectors actually that gained tailwind over the last couple of quarters, and are still going to gain tailwind going forward. I mean, I gave you some examples already. I mean, China's opening up financial markets, capital markets. So, I mean, what we have seen already over the last couple of quarters, that more companies are moving over to get a listing in Hong Kong. So, I think this is great news for the capital markets in Asia, for the Hong Kong capital market. So this is really going to be beneficial for Hong Kong, because there are not so many things the Chinese government and the US government agrees on, but they agree that they don't like Chinese companies being listed in the US. Another sector we really like, and I think there's lots of growth ahead, is insurance markets. And typically you have substantial increase of demand for insurance products when the GDP per capita crosses the $10,000 mark. And you have that for many of the provinces in China right now. At the same time, I mean, people are more opening up to get insurance. I mean, giving the fact of COVID is also a fact. And as I mentioned, I mean, the government is really, really supportive for companies growing there in that space, also opening up the space for foreign investment. So insurance, I think, is a great sector also to play the rising middle income theme. And the government, they talk a lot about common prosperity, and the target for that is obviously you want to make sure that not only a few people are getting rich, but that the majority of the people are getting more wealthy, which should be great for consumption. And then, if you're talking about restrictions for gaming, and the government just announced new regulations, and there have been lots of talks on restricting kids to play too much online games. And obviously, the government didn't like kids just to spend the time in private tutoring courses, but obviously as they have lots of spare time now, they don't want them to play games instead, right? Instead
3
of
hours.
learning.
They have 3 hours a day.
That's it, right? So that's the reason I think the government is really supportive for people doing more sports, kids doing more sports. I mean, sportswear companies are benefiting from that theme as well. And last but not least, I mean, we're talking about strategic sectors. The government likes to push renewable energy, for example, electric vehicles, semiconductors. So all these sectors that are important for a government for strategic reasons to gain market share against the US, I think also interesting from an investor's perspective. I have to say some of the sectors, you need the Asia market, difficult to invest in Hong Kong. Some of the sectors are also pretty expensive, but I think from a portfolio context, you want to own probably some of the beaten down names in the tech space, because I mean the street is extremely bearish, valuation is extremely attractive. We don't know the bottom, but you know that in 2-3 years' time, these stocks are trading higher. But you also want to add some of the names to your portfolio where you have decent tailwind coming from government policies. So it should be a mixture.
So, Ken, we took a look at Eastspring's China A growth strategy, which significantly outperformed peer group average since its inception. And I just want to know what has changed in the portfolio in the wake of potential government targets for regulation. And same question to you. So where do we go from here? What are the sectors the team is going to watch in months ahead?
Okay. The fact is that when you look at overall, sort of the benefits, I think when you look at A shares, the most important aspect of A shares is that it's very diversified. You can see on this particular chart here that there's quite a lot more A share stocks listed in Shanghai and Shenzhen as compared to the offshore markets. It's much more diversified. So when you have a sort of a much more balanced set of companies within consumer discretionary, IT, materials, consumer staples, healthcare, materials, industrials. There's a lot of these type of companies within the A share perspective. For us, one of the key reasons why, especially for this year, why we perform quite well versus our peers is the fact that, we saw a shift. We saw a structural shift where markets became more cyclical. And so earlier in this year, what we decided to do was we closed out our underweight position towards the Chinese banks because we felt that potentially interest rates would gradually start to climb, and so net interest margins would actually start to improve for Chinese banks. But at the same time, we also saw that potential for a rise in inflation, or at least on the manufacturing side on the PPI index. And so for us, we increased exposures to materials, and that really has also sort of helped in what we've been able to achieve. Over the past few months, some of the key sort of areas where we've seen opportunities are really within, for instance, the EV space, within specifically the solar areas, within specifically the semiconductors, with some of the chip makers, and then also at the same time, healthcare and also consumer discretionary. And healthcare for us, it's not necessarily your, sort of your staples or your very, sort of pharmaceutical related names, but it's actually more about, sort of cosmetics, right? Dental companies, people doing, let's say, plastic surgery and sort of like those discretionary spend on the healthcare space. And, we just see that as really sort of that China's really push towards consumption. Don't forget, the fact is that consumption as a percentage of China's GDP is still only around 56%. And then when you compare that with other developed markets like the U.S., Japan, or even in Europe, a lot of the consumption numbers are now more closer to about 80 plus percent, when it comes to consumption as a percentage of GDP. So because of that, that's why China still has ways to go to really improve on its services as well as the consumer sector. So we feel that this is going to be very much a long-term structural sort of shift in which consumption will continue to be a very key part of China. Healthcare with that aging population, that's going to be an important aspect. We talked about technology. The fact is that, again, the hardware side of the technology, because it's very important for China to become much more technology independent, a lot less reliance on, sort of other countries like the US, South Korea, Japan, for their products. Especially, we've seen how the chip sector has seen quite a bit of shortage. And so China has really have to find ways to really develop its own chips. So all these things are going to be important. And then, of course, the whole EV space. And for us, not necessarily focusing on purely just the EV car makers, but the suppliers. A company that we invest in, Kale, Contemporary Amprax, they're actually the biggest EV battery makers in the world. And more recently, they're now supplying the batteries to Tesla's Model Ys, and I think also Model 3s as well, for their standard range vehicles. Because the fact is that they're seeing a lot of demand. And again, for them to develop that particular battery for electric vehicles are definitely, sort of much cheaper as well. And so, we see quite a bit of benefits. But again, there are a lot of moving pieces. But that's why also, we've been able to be quite successful, because the fact is that, with our top-down approach, when it comes to investing in a market like China and with our China A strategies, we spend quite a bit of time understanding about policies. What are going to be policy headwinds and what are policy tailwinds. We spend a lot of time understanding about the economic figures which are coming out, or expectations on economic figures. And then we also spend quite a bit of time on liquidity as well. And so for us, under different scenarios, we've got specific, sort of ideas as to, sort of where we should be, overweighting a particular sector and which sectors we might be underweighting as a result of a lot of these specific signals that we're seeing from a top-down perspective. So I would say that's really sort of one of the key distinct advantages that we have, that we are able to try to, understand what's going on and how policies can have a large impact in a market like China.
Mm-hmm. Thank you, Ken. So let's also talk about the property market. What is happening there? One of the major segments in Chinese economy. And following a statement from the housing ministry that China will strive to clean up irregularities in the property market in 3 years, China's largest developer, Evergrande, has been ordered by the regulator to resolve its debt issues. So, Martin, could you shed some light on the Evergrande case, because we are seeing bubbles and people are wondering whether it's going to default, and it's maybe share your view on its impact on the Chinese financial system. Do you see a widening crackdown given the government's effort to rein in overheated property market and potential contagious risk spill, across the sector?
I think, first of all, it's really important to understand why the property market is so important. Why should we care about talking about the property market in China? And the answer is quite simple. I mean, it's the overwhelming importance of the property market for the Chinese economy, and the contribution is more than 50%. And it's also extremely important. It's a savings category for households. I think when you talk about urban household assets, actually the property category makes up like 60%. But obviously also for the financial system, the property market is essentially accounting for a quarter of banking assets. Yeah? So that's the reason we all care about the property market. Investors should care about the property market. So it's not the same as in countries like Germany, for example. Yeah? So for China, the contribution of this market is really huge. So now, what is the problem currently? And I think we discussed it before. The government is tackling the inequality issue. We have a demographic problem right now. Housing prices in Chinese cities are extremely high, and actually for cities like Beijing and Shanghai, they're among the highest in the world. And I mean, President Xi once said, houses are for living, not for speculation. Yeah, which is probably explaining what the government wants to achieve there. So it's actually the same policies we've talked before, making housing more affordable, preventing speculation. And obviously, there are some of the developers who have been growing into the most best developers in the world. One example is Evergrande. And obviously, it's not that easy to manage the issue. I mean, in former times, a couple of years back, I mean, the property market, because of the importance for the economy, was always considered to be a tool for the government to stimulate the economy by stimulating the property market, or doing the opposite, yeah, and just trying to cool down the market by coming up with some restrictions. And I think these days might be over. The government clearly said that we have an issue on affordability, we have an issue on the debt position, but what the market is really concerned about is the balance sheet of Evergrande, and we're talking about a huge pile of debt, actually I think more than $100 billion USD when we talk about interest-bearing asset and debt positions. So it's really important to fix the problem. And I think the government has been the trigger for these issues. As a discovery came up with measurements to cool down the market. So I guess the government is still the driving seat. They're still in control, but the whole market is now asking the question, is the government going to step in to bail them out, or do investors have to take a part of the haircut? And that is really the issue right now in the market. So we're going to see how it's going to sort out. I mean, as I said, I still think the government is a driving seat because it triggered this issue via the cooling measurements. But at the same time, we really have to find a solution for the situation, because obviously the company is losing trust from investors, from banks. So I think we need a solution over the next couple of weeks and months. So it's not a thing we can wait for a couple of years.
Yeah, it's actually interesting talking about bailouts, So again, a failure on the scale of a great rhino like Evergrande would ripple across the economy and spell financial ruin for ordinary households. But such a public intervention, like this from the Chinese government is very rare on a private company. And not to mention it happens only 2 days after the Huarong bailout. But Huarong is a state-backed state-financed company. Do you see a bailout for like Evergrande? Do you see a systematic risk for the Chinese economy in general?
Yeah, the fact is that, again, there's no right answer as to whether or not, a bailout is warranted. It's the fact that, it could happen, it might not happen. It really depends on specifically, sort of what the regulators and the central government thinks about it. The fact is that when you look at the, sort of the property, tightening, it's happened 3 times over the past 11 years, right? We've seen how the sector as a whole has degraded significantly. If you look at, sort of property now as a percentage of, sort of the MSCI indices, it's like 1-2%, right? Or at least in the mainland China A shares, it's now down to about 1%. There's always, talks of, too big to fail. There's always those types of discussions as to, what could potentially, sort of happen, and could it cause a ripple effect? And, it could. And this is where, it's important to see specifically, first of all, how companies deal with those certain situations, especially those companies which are over leveraged. And then, we just kind of have to figure out and to understand, sort of what's going on. And from our point of view, that's why we would rather invest in companies that tends not to be as highly geared, companies with a sustainable business model without the need for government support in order to sort of bail them out. And so that's why it becomes very important for active stock picking and for investors to really understand specifically what companies they should focus on. So instead of identifying sort of individual companies who might need to be bailed out, first of all, as an investor, we want to be avoiding sort of those companies altogether, and not be involved in those types of investments. And again, that's why I think having that active element approach when it comes to investing in China is definitely the way to go.
So for investors who are in for the longer term, and let's talk about maybe China's growth outlook. Martin, do you see a new cycle of stimulus from PBOC or the government, given that growth is losing a bit steam after a spectacular V-shaped rebound from the first COVID wave in 2020?
I mean, that is actually something investors would like to see. Sorry, that's a background noise. Should we maybe get on mute? Okay. All right. I think talking about a potential stimulus, I think that is actually something everybody would like to see right now. And as he said, right, I mean, China was the first big economy out of the crisis triggered by COVID-19 last year. The only big economy that was still growing last year, actually. So it was also the first economy that was tightening a bit at the beginning of the year. And also, if you compare the situation to the rest, and if you look at how much leverage the Western countries are taking right now, China is following a different approach this time, and I think they also learned their lesson from what has happened after the financial crisis, when they were taking a huge step to fund infrastructure investments, and this created lots of problems in terms of high debt levels and so on. So they didn't want to do the same this time, and they were pretty cautious. They were pretty prudent and taking away the stimulus somewhat after they thought we don't need it any longer. But as you also mentioned, I mean, the economy is losing steam right now. It's pretty clear. If you look at industrial production, if you look at retail sales, if you look at the PMIs, I think the economy is slowing down probably a bit more than what the government or the PBOC would have liked to see. And actually, there's some indications that we might see some easing. I mean, a couple of weeks back, they did the first step by reducing the reserve requirement ratio for banks, and I think it's pretty possible, given the big numbers, that we would see another rate cut or maybe even some cuts in the interest rate. So actually, why?
Martin, hello. Okay, while we're waiting for Martin, so maybe I have another question for you, Ken. How about you, Ken? Where do you see the biggest tail risk now? And is it an inflation, a taper, and policy, or the COVID?
The fact is that there can be quite a number of different things, right? The fact is that I think China has mostly resolved sort of its COVID issues, and the fact is that when you look at sort of my counterparts and my colleagues based in Shanghai, Beijing, and so forth, they're able to travel throughout China, visiting companies, doing site visits, attending conferences, and so everything seems to be sort of much more back to normal. The concern, obviously, a lot of times will be is whether or not growth can continue to be sustainable over the long term, because we know for a fact that investments cannot be a big part of economic growth going forward. I had this chart here where you can see that contribution to China's GDP, by various industries, from sort of the primary industries used to be key for agricultural, then gradually became secondary industries, which are more sort of construction and manufacturing, and now it's moving more towards the tertiary, which is part of services. So China's real GDP growth, when you look at the sort of the left picture here, has started to decline, and so the urgency of reforms has risen as growth continued to slide. So obviously, this is going to be one of the key things where we think that there's going to be more opportunities being embedded into secondary and tertiary industry, so more towards construction, manufacturing, as well as the services sector in China. So that's going to be really the key aspect. And so as a result, in order for China to continue to grow, and in order for China to sort of have a sustainable sort of push for its economy, these things are all going to be very important. And so we think that as time progresses, as China can continue along this particular path, continues to sort of allow the markets to operate, sort of in, more independently, without, sort of maybe potentially with a bit less, sort of regulations, and hopefully that should enable to attract more foreign capital to feel more confident investing in a market like China, which also at the same time then would allow for the Chinese equity markets to re-rate at a much higher level. I mean, there's absolutely no reason why global investors should be 4% underweight China, but that's exactly it right now. Global investors right now are at the highest point in which of their underweight towards China at over 4% for their global equity funds. And so, when you look at a situation like this, there's definitely plenty of opportunities there. And, once investors do feel more confident about a market like China, we would expect that to significantly decrease and, change from maybe an underweight to an overweight.
Martin, I think we lost you in a halfway while you were answering the question about whether China would, where we're looking at China for its growth outlook, and would it recover, or what you're seeing. Apparently, you're seeing a little slowdown for the Chinese economy. And could you continue to share your view on this?
Sure. I think I'm not so sure what you guys got, but I mean, as I said, I mean, we've seen China being the first economy out of the crisis last year. We've seen them taking back stimulus at the beginning of these years because it was not necessary any longer, and they are also cautious about raising debt too much. They've learned the lesson from the financial crisis. But when we look at how the Chinese economy developed over the last couple of months, especially, we've seen quite a bit of a slowdown in activity on the retail side. When you look at retail sales numbers, if you look at industrial production numbers, So I think it's pretty likely that we're going to see some selected stimulus from the central bank. We've seen a first step already when they cut the reserve requirement ratio for banks a couple of weeks back, and I think there could be another cut. And I guess we could even see some interest rate cuts. So it's quite interesting again that China is in a different cycle somewhat to the US or Europe, because I mean we're talking about tapering for the US, for example. In China, I think we could see some relaxation in policies, also to account for the slowdown in the property market, which is quite important as we discussed, and which is also having a quite negative impact right now, I think, on growth. So I think then the question is how the market would react. I think it's quite interesting sometimes when you see that actually numbers are coming in weaker than expected, macro numbers, but the markets are actually rallying on that. Exactly the time when investors thinking about potential stimulus packages. So I think this could actually be positive for the sentiment in case the economy doesn't fall and the people will be stimulated.
So before we open our Q&A session to the audience, let's take a look at a U.S.-China relationship. I got a question for you, Martin. Will a Biden administration reduce the risk premium of geopolitical tensions? How does it impact the market?
Yeah, I think it's interesting. Yeah, when you look at the U.S. position when they talk about China, I think the Republicans or Democrats, they don't agree on so many things, but they agree on policies. I mean, to tame China. Yeah, and obviously when Biden took over as president, I mean the whole direction of China policies didn't really change. I think the U.S. recognizes that China is a challenge, and it's going to be the new superpower. So it's not going to be a risk that it's going to go away over the next couple of years. I don't think so. I think what changes maybe the tone. Yeah, so it's not Trump any longer, it's Biden. But I don't really think, also having in mind that we are going to see midterm elections in the U.S. next year. I mean, you want to be tough as a U.S. politician on China. So I think this is also going to be the line of the Biden government. And then the interesting question is, how are the Europeans gonna behave? Obviously, Trump didn't really coordinate his policies with the European leaders. I think it could be somewhat different for Biden. I think he talks a lot with the European leaders to find common stance on China policies, which would also put Europe in a quite delicate position, because it was obviously much easier to say no to Trump than it is to say no to Biden.
Yeah. So how about you, Ken? Do you agree with Martin on this?
Yeah. The fact is that we feel that geopolitical tensions between China and the U.S. will continue. The fact is that you're at a point now where both countries are, sort of really, are really, sort of in a very direct competition with each other. Maybe less so in terms of maybe some of the, sort of barbaric types of talks that we've seen previously with former President Trump. But more so now, what we're seeing is potentially, challenges and, competitions maybe on the green side, right? President Biden wants to push the green initiative, push more EV vehicles. So we could see potentially competitions in terms of which countries can produce more electric vehicles out on the road, or which country can, sort of be carbon neutral quicker. Or sort of which countries can lead the world in renewable energy generation. So there's a lot of these other things which there could be tensions in, and so that's why these things will not go away. The fact is that when you look at the overall sort of geopolitical barometer, there's still going to be quite a lot of different things, but maybe not not so with some of the sectors that we've seen previously. But at the end of the day, it's always about navigating through some of those uncertainties which are out in the marketplace and which will continue to be out in the marketplace, and to really just identify sort of the areas and the sectors which could potentially benefit as a result of those competitions. Like I mentioned earlier, right? Technology dependent is something that's going to be very key for China. And if technology dependent, it's going to be very important. And we talked about why semiconductor, is a key thing, right? Chips, semiconductor chips are going to be very important. So we take advantage of those situations. Take advantage of sort of some of the areas where for a fact that policy tailwinds will really help benefit certain sectors, and try to capitalize on those particular sort of policy supports, and try to identify sort of the really strong companies which are going to be able to sort of capitalize and benefit the most from these policy shifts in terms of helping these companies. So really it's about identifying those opportunities from our point of view.
Okay, so let's wrap it up with my last question about award decoupling. US and many of its allies are paying firms to leave China and shift production elsewhere, and efforts to tier up, rebuild, and reshore supply chains are getting momentum. Actually, on the other side, China plans to ban US IPOs of data-heavy tech companies, and lots of Chinese firms, particularly US-listed tech companies, are paving their way back on the Hong Kong Stock Exchange for a second listing. So could you help us to our investors to understand the macro trends and industry impacts of this decoupling process, and how would it play out for Europe? And let's maybe start with Martin.
I mean, that is indeed what we are seeing right now, the tendency of decoupling between China and US. And I mean, actually, to talk about, or to give some background, I mean, China announced a very ambitious plan to become independent from foreign supplies, right? So-called Made in China initiative a couple of years back. And core was to achieve leadership in a range of sectors, in particular in high-tech segments like semiconductor, artificial intelligence, and so on. And that was obviously a provocation for the US, right? At the same time, the trade deficit with China for the US reached unsustainable high levels. So obviously the Trump administration started to enact some policies to contain China and contain the rise in these tech segments. And one extremely important segment is obviously the semiconductor industry, that China had extremely ambitious plans, because, I mean, at the end, China is the biggest user of semiconductors, biggest user of some key parts, but in terms of market share, it's still pretty low, so it's really key for them. But having in mind the sanctions of the US government, sanctions on delivering core equipment to Chinese companies, this is going to make it really, really tough for China to catch up, from my point of view, just because, I mean, US is dominating the whole semiconductor chain. So whenever there's a US patent, US technology or software component, and this is across the whole value chain in semiconductor, a company is not able to deliver the technology to China. What are the implications? I mean, first of all, it's going to be tougher for China, to achieve their targets to grow the semiconductor industry, from my point of view. On the other hand, it could also potentially be dangerous for the US. I think it's going to be tough here to catch up, as I said, but in case the Chinese manage to catch up and maybe building up their own value chain, which is not dependent on US technology, it could also impose a more serious challenge for the US. So it's going to be really exciting to see what's going to happen. I think again for Europe, it might be probably a negative thing, because we have more two standards then, right? We have that already when you talk about the internet platforms. Google, Facebook, Amazon, they effectively don't have a presence in China, so it's nothing new to the big internet companies, but you could see the same in other sectors, that we have a division in the so-called decoupling between China and US, which would make it more expensive also for some countries like Europe. But it's definitely going to be a key point for the Chinese to catch up technology-wise in these key segments, to become independent from US supplies.
So how about you, Ken?
Yeah, I mean that's I think we haven't really used that word in quite some time when we talk about decoupling and so forth. The fact is that both countries have their own sort of sort of ways in terms of how they're go about in terms of generating growth and sort of how they'll continue to evolve. We live in a global economy where specifically there's really a strong need for global trade, and in these instances, we expect to see, again, at least in the short term, there are still going to be, sort of conflicts, and again, it's not just between the U.S. and China. It's certain conflicts across the world, right? Every country wants the best for itself and its own citizens, and again, at that point in time, it's always going to be certain points of competition that's really going to sort of impact how things are. But again, I just want to allude back to that earlier point that I made, which was, if you think about it right now, if China's going to be approaching sort of the U.S. when it comes to the overall size of their economy, let's say within the next decade or so, as an investor, and when you're investing, how much of a difference in terms of exposure should you really have between U.S. as well as China? And I think that should be a key question that investors should ask themselves. The fact is that most investors will tend to have a significant amount of less exposure towards China as opposed to the U.S. Rightfully so, right? U.S. is a developed market and China is an emerging market. But how much of that difference in sort of the exposure gap investors have, that is something that you really need to think about, especially in the coming years when China is definitely in a position where they're going to be approaching the size of the U.S. economy. And in instance, in that way, a lot of investors will really have to seriously think how they should be, sort of positioning their portfolios within China to capture some of those economic gains. And from our point of view, the best way really to do that is definitely going to be investing in the A-share market, which attracts and has a lot of exposure of that China economic growth for the foreseeable future.
Thank you. Unfortunately, we have to stop here in the interest of time. A very big thank you to Ken and Martin. Thank you both for being here and for this very insightful discussion to help our investors understand the recent regulatory crackdowns in China. But my apologies for the technical interference. We will edit the clip for better viewing experience, apparently. And so, yes, there are crackdowns sweeping across tech sectors, across real estate sectors, and across education sectors in China. But when you take a step back to look at a bigger picture, there's threat running through all the policies that are coming out of it. And that's all in the longer term reform that we all hoping to see with China. So this probably creates a better environment for global investors in a few years. I hope you all enjoyed today's Portfolio Manager Conference and leave better informed. Have a wonderful day and see you next time. Thank you, Ken.
Thank you.
Martin.
Bye.
Bye.